Good morning, it's Jeffrey Christian of CPM Group, 11 a.m. on Thursday, June 9th here in New York. This is our silver online seminar. It's the second time that we've done one of these in conjunction with the Canadian Prospectors and Developers Association of Canada annual convention. Get back to that in a little bit. We're calling it Silver Truths because I want to try to focus on a positive message about what silver really is, as opposed to spending my time knocking down misstatements and misunderstandings. Obviously, in speaking of the truth, I will be talking about what's not true too, but we'll go through that. Hopefully, I'll be able to run through this relatively quickly, 30, 40 minutes, and that'll give us 20 or 30 minutes for question and answers. My partner, Carlos Sanchez, is working on some other things today, so I would be answering the questions that come up. If you do have a question, there is on the webinar panel a place called questions, and you can type in the questions, and then during the Q&A period, I will try to read the questions and answer them as we go. As always, I have here our Silver Yearbook 2022, which we released in early May. And as always, we need to thank the sponsors of this. And again, this is part of our PDAC event. So we will be having a silver reception during the Prospectors and Developers Association of Canada annual convention next week. And then we will have a booklet that the sponsors and CPM Group will have to distribute, which basically covers the same territory as this seminar. But you can see a host of 14 different companies sponsoring it across the industry. So we do have some silver development and producing companies. We have economic research groups. We have EELO Solutions, which provides environmental energy consultancy to the mining industry. Fortuna Silver, Endeavor Silver, Kitco Media, Coralin Metallic Minerals, the Electrum Group, which includes Sunshine Silver Mining and Minera Andolaria, Prospector News, Pan American Silver has been a long-term sponsor. Silver Corp has been, Silver One, we're welcoming, and the Prospector News. So we have to thank all of these guys, entities, for helping us make all of this free information available to the silver market. Now, the origins of the Silver Facts and Fantasies. Last year we did one of these, and it was in early March because the Prospector PDAC normally is the first week of March in Toronto. And CPM Group has had a silver reception for about 18 years on opening night of the PDAC. Last year, because of the pandemic and the lockdown and travel restrictions, the PDAC was virtual. You can't really have a reception virtually. So in lieu of that, we had this online seminar. And at the same time, we had an enormous rise in spurious and inaccurate silver marketing hype on the internet. Some of it came from people who have been talking about, silver prices going to the moon for decades and have been wrong. Some of it came from new entrants. Some of it seems to have been paid for or sponsored by people who are historically misrepresenting gold and silver and other metals to investors and making a lot of money selling them metal storage programs, and equities. So given this plethora of bad information and circulating the markets at the time, we were talking to the people who normally sponsor our silver reception. We said, let's do this online webinar seminar. And we called it Silver Facts and Fantasies. This year, I'm retitling it Silver Truths because, I'm trying to have a positive view of the world. So what are the silver truths? I'll run through a bunch of charts and tables, but here they are, just in highlights. Silver prices are high. You hear people talking about how gold and silver prices are low. Gold's at record levels. Silver is very high. It's not as high as it was 2011 and 2012, but if you take those 2 years out, silver is far higher than it has been historically in real and in nominal terms. And it's also much higher than the $14, $15 that we saw from 2015 till the middle of 2020. So silver prices are high. And I will say, there's this strange thing that people talk about. Silver is going to reach $50, and it's like some magic number. Like, why is 50 a magic number? Why is that your target? Well, it touched it for moments in January of 1980, and it touched it for moments in late April 2011. Therefore, it's somehow or other a very important number that will be reached again. And then, of course, the charlatans that populate this whole realm say, well, 50 is not good enough anymore. They were saying it was going to get to 30. It hasn't gotten to 30. It's going to go to 50. It hasn't gotten to 50. Now they're saying it's going to 100, or the upper 3 digits, like 700 or 800 or $10,000. There's one guy who says that you'll be able to buy a house, which is going for about $400,000 now, with like 10 ounces of silver any day now. He's been saying that for about 20 years, and he'll probably continue to say it until someone carts him away or he dies. That's just the nature of that silver market. That's one of the silver truths that we have. The market has those kinds of people. If the price of silver rises to $50 again, and CPM Group actually does think it will at some point in the next several years, not now, probably not in 2023, but some point in this decade, we do think that you will see $50. And the key is to understand it won't stay there. It will come back down, because that's what silver prices do. That's what asset prices do. World's not running out of silver. I'll run through those numbers. Supply, I'll show you some numbers about silver supply costs so you can better understand that. Fabrication demand, I want to talk about silver use in electronics, solar, and electric vehicles. And, I just have this line here. I don't have any charts for it. But one of the truths of the silver market is that it's full of charlatans and scammers and liars and people who simply don't know what they're talking about. And we've seen a lot of these guys gain prominence on the internet year and a half. And it's caused a lot of investors to lose a lot of money. And as I said, it seems that at least some of these guys have been financed and encouraged to do this by people who have a history of misleading investors. So let's go. Silver prices are high. This is a longer term view of the price of silver. And you can see, yes, it's spiked up. These are monthly average prices. So the intraday high of $50 in the first quarter of 1980 shows up as $37 because that was the monthly average. And then you can see it got up to about $43, $44 on a monthly average basis in April of 2011. And it stayed high 2011 into 2012. And then it came off and it traded much lower. And you can see on my next slide, this is really since 2011. You can see that peak. And these now are daily high-low close prices. So you can see the $50 in April of 2011. You can see how it came off sharply and traded between really $26 and $36 during 2012. And then in 2013, it came down and down and down, and it got down into that $14, $15, $16 range, which it traded in really from 2014 until July of 2020. Rose very sharply in July and into August of 2020, along with gold and a lot of other assets. That was 3-4 months into the global economic lockdown and recession. You had seen the prices fall sharply earlier in March when the lockdown began, and then the price came back up, and people were becoming more fully cognizant of the nasty state of the world, politically, economically, financially, socially, and you saw the prices spike high. Some people were foolish enough to buy at $30 at that point, and some of those people have sold. We had one person who had come to us and suggested that she might retain us as an investor client of ours. And we were telling her about the wisdom of owning silver. This is back in 2018, 2019, maybe even earlier. When the price rose to 30, she bought silver. The person or the company that she bought it from sold her silver coins. And we like silver coins, but this was an enormous amount of silver coins, more silver coins than you need. And this was at a time when the premiums of the silver coins had gone through the roof. She came back to us and said, gee, maybe I should have used you as an advisor. We helped arrange for her to keep some of those silver coins, because you should have silver coins, but that most of the silver that she had bought, because the premiums were still high on coins, we were able to arrange for her to sell those coins and buy 1,000-ounce bars stored in a secure facility for her, and come out with about, I think the number I remember is about $750,000 that she was able to recoup from what she had spent buying coins at the peak of the market in August of 2020. Now, the price actually was higher on an annual average basis last year than it had been in 2020, because in 2020, it spent the first 6 months of the year below $15, $16. And it only really started rising in July of that year. So you had 6 months or half a year of high prices in 2020. You had a full year of high prices in 2021, and the prices are pretty much continuing in that vein now. Our expectation is that the prices continue to consolidate the rest of this year. Some weakness coming up. I'll talk about that in a second. But we think that the prices continue to consolidate really above $20, $21 an ounce over the next 6 quarters. And that at some point you will see another ratchet upward in silver prices, probably beyond 2023 is our best guess, but it could happen at any given time. Will it go to $50? Will it go to $30? Probably not this year. Will it go to $50 at some point? Probably. And intelligent investors will either sell it and take profits, looking to reposition themselves at lower prices, or they will keep their physical silver and they'll buy some puts to protect themselves for the inevitable decline in the price. Because silver, like gold and like other freely traded markets, rise and fall. They don't go to $50 and stay there. You can say, oh, this time is different, but don't say it to me, okay? I mentioned seasonality. Here's the seasonality. And you can see that the strongest period of time typically for silver prices is March, April, May. We've gone through that period. We're into June now. And you can see that from June, really through October, silver prices tend to be weak. There's weakness in fabrication demand in the jewelry industry and silverware and electronics to some extent as well. And there's typically some weakness in investment demand during this period of time too. So seasonally, there's a inclination to see lower prices in the third quarter. And we think that that probably will put some downward pressure on silver prices over the next few months. We don't see prices falling below $20. We see them going, maybe staying above 21, but we do think there's some scope there for longer term investors to pick up metal at $1 or $2 lower than it is right now. Longer term, I said, we do see it. Okay, now one of the things is the world's not running out of silver. It's not running out on a mineable basis. And you hear these people, it's great, nouveau people. There's a guy who didn't know that it's Fresnillo. He kept calling it Fresnillo. And he was talking about how it's been around for 10 years because Peñoles, which owns the Fresnillo mine, spun off Fresnillo as a separate company about 10 years ago and listed it on the London Stock Exchange. The Fresnillo mine actually started in 1554. It's been running for like 468 years. And incidentally, it's probably never had more than 5 or 10 or maybe 20 at sometimes years of mineable reserves. Because Mexican mining companies like Peruvian mining companies and Chile and Chinese mining companies tend not to prove up reserves. I have a mine that's been running for 4.5 centuries, and we just keep growing it, and we understand the deposit, and there's no real reason for us to spend a lot of money drilling out the reserves and proving that we have another 500 years worth of silver there, because we know it's there. And what's the value of that? We can focus our capital expenditures on actually mining and mining well. Again, you go back to the 1970s, 1980s, and you can see people were saying, oh, we're going to run out of mineable silver. And at the time, you had about 8 billion ounces of mineable silver in the reserve base, which is a subset of resources. But it's basically reserves and reserve base the reserves are mineable resources that are economically profitable to be mined at or near current prices. And the reserve base says that it's resources that are likely to be profitably mineable at reasonably expected future prices. 8 billion ounces in 1981. By 1988, the USGS and others were publishing reserves, and you had about 7.8 billion ounces in reserves and about 10 billion ounces in the reserve base. And we were producing probably about 500 or 600 million ounces of silver a year at the time. I have a production chart that goes back that far toward the end of this presentation. Since that time, 1988, the world has mined 20 billion ounces of silver. We had 7.8 billion ounces of mineable reserves in 1988, produced 3 times as much. And at the end of 2020, we had 16 billion ounces of reserves, twice as much as we did at the start. If you understand basic geology, you understand why that is. If you don't, or you choose to ignore the reality of silver mining and mining in general, then you can say, oh, we're running out of mineable reserves. And you can say, okay, 16 billion ounces of reserves at present, and we're mining close to a billion ounces of silver a year, 800 million. So yeah, we only have about 16 or 20 years worth of reserves left at present prices, given what we know. And the kicker is there's a lot of resources that don't show up in reserves. And a lot of those resources are in countries like China and Eastern Russia, where that metal doesn't show up in data that's collected in the broader global economic environment. That data tends to be excluded. That data tends to be more resources and less reserves. And when those stuff gets mined, and it will be mined by Chinese and Russian companies, not by people who list in the Toronto or New York or London stock exchanges. So there's plenty of silver to be mined. The world is not running out of mineable silver, despite what people have been saying since 1970 or so. And there's plenty of silver in refined form, either in bars or in coins. The blue part here at the top, or green, depending on your eyes, is coins. And you can see there's been an enormous growth of silver stored in coin form. And there's a variety of reasons for that. And then everything else is silver bullion bars. And you can see there's about 3.5 billion ounces of silver estimated to be in bar form globally, as well as another 1.5 or whatever billion ounces in coins. So a lot of silver in refined form. You say, well, yeah, they're not going to sell that. Well, people sell it and buy it every day. COMEX inventories, near record reserves, Some of the charlatans and scammers like to point out that the registered stocks have fallen from about 150 million ounces to about 72 million ounces over the last year or so. They fail to point out that, that's still higher than it was prior to, say, 2019, 2020, and that you still have very high numbers. And they fail to point out that insofar as a lot of the silver that's come out since late 2021 has come out of registered reserves, they're staying in the eligible reserves. They're not moved. That's physical silver is not moving. The owners are deregistering it because they're less active on the COMEX, but they're leaving it exactly where it is. So the eligible stock, that's silver that is stored in COMEX registered depositories that meets COMEX delivery specs, 1,000-ounce bars, coins, smaller bars, and other things are excluded. The eligible reserves have been relatively stable. Yes, they spiked up during the early days of the pandemic when a lot of people were selling metal because they wanted money and because the price had risen. They came off from that 400 million ounces to about 350 million ounces, and they've been pretty stable ever since. So anybody who says that they're draining the COMEX is fooling themselves at least, and probably trying to fool you too. COMEX has plenty of silver. Shanghai Futures Exchange has plenty of silver. It's only been around since 2012, but you can see that the stocks have grown. There's a lot of other silver that is known to exist in 1,000-ounce bars in depositories throughout China that doesn't show up on the Shanghai Futures Exchange because it's not being used as collateral for futures trading. And then London stocks, oh my God, they're off so sharply from their record level in late 2020 to near record levels. So there's plenty of physical silver around. It's in central markets like COMEX depositories, Shanghai depositories, and London depositories. And a lot of it, most of it, actually isn't in those places. It's in those other places where it doesn't show up in data. Because silver investors, like a lot of other people, like privacy. Again, people will say, well, if you look at the open interest of COMEX inventory and compare that to inventories, there's not enough. And if everybody who had open contracts, most of which are in the first nearby active futures contract, if everybody took delivery, there wouldn't be enough silver. And, that's true, but it's meaningless. There's an old joke about an economist, and he says something to a fellow, and the guy says, "You must be an economist." He says, "How do you know?" He says, "Well, because everything you say is true, but it's meaningless to humans." 99% of the people who have open interest, long and short, on the COMEX are there for the price exposure, not for the physical metal. They don't take delivery. I'll show you in a second. So you can say, yes, if everybody that has open interest took delivery, the price would skyrocket. But that's like, well, I won't say what it's like. It's a spurious argument that would be only raised by someone who likes to make spurious arguments, either because they're truculent, obstinate, or trying to fool investors into thinking that the silver market is much tighter than it really is. The way to look at it is the deliveries versus the inventories. And here the red line is inventories, and you can see 340 some odd million ounces. And the deliveries are the blue bars, which generally speaking are on the order of 5 to 50 million ounces in a given month. That's the record. So you have an enormous surplus of inventories relative to deliveries because the COMEX really isn't used as a place for physical deliveries anymore. It used to be in the 80s, 70s, and 80s and 90s, and you can see here percentage of COMEX futures deliveries relative to open inventories was up there. It was 20%, to 30% most of the time, sometimes spiking much higher. But over the last 20 years, over the last quarter of a century, over most of the period of time when most of the people in the silver market were not in the silver market. I started in the silver market back in the 70s, so yeah, I was there for that. But you can see that the COMEX is not a place where people say, oh, I'm going to take physical delivery. It's a place where they say, I want to buy leveraged exposure to changes in the silver price. A little bit about investment demand. Investment demand comes and goes. In the 1960s, when it was quite clear that the price of silver had the pressure of silver on silver prices, which had been kept below $1 because that was the price at which you could take silver certificates issued by the US Treasury to a nationally chartered bank and say, I want the Treasury silver for $1. And you had coins where you had a melt value of $1.29. So even though it was illegal to melt coins down for the silver, there were hundreds of millions of ounces of US silver coins that were melted down in the 60s. Investors were buying a lot of silver in the 60s. When the price was freed, Treasury got out of using silver either to back certificates or use it in coins. And once that was done, they let the price of silver run. Silver price went up to $5. People started selling their silver. These are guys who at $1.30 said, I will never sell this silver. You can say that this silver exists in inventories, but hey, it's not available to the market. Oh, wait, the price just went up fivefold. Here's my silver. They sold it. Then the price started going from $5 to $50, and they bought it back. Then the price went from $50 to $16 in one day. Actually, it went from, I guess, about $32 to $16 in one day. The price came off, and it continued to be weak through the 80s. And slowly, investors were buying less and less silver. And then by 1990, they were net sellers of silver. And they continued to sell silver more than 1 billion ounces from 1990 through 2005. And after they had sold off all that silver at $4.5, $5.5 an ounce, they said, gee, that was probably a mistake. We should start buying silver again. And they started buying silver again. And you can see the line is the price. The price of silver was pretty much flat, around $4.5, $5 an ounce during that period of massive disgorgement by investors. And then as investors were pulling back from selling as much, they went from selling, 150, 200 million ounces a year to selling maybe 50 million ounces a year. Then the price went from $5 to $10. And investors said, whoa, the price of silver just doubled. I think I shouldn't have sold that silver at $5. I'll buy it at 10. And as they started buying, they became net buyers again, and they started buying 150 million ounces of silver a year, and they drove the price to $50 on an intraday basis and to about $35 on an annual average basis in 2011, 2012, at which point they said, well, maybe that was too high. And they pulled back and the price fell back. And now they're buying more silver again. And the key to understanding where the silver price is going to go is to project how much silver investors are going to want. And that's a difficult job, further complicated by all of the static and noise that you have in the market from other people. Now you can't see this. This is a quilt chart. This is a 11 different financial assets: large cap US, small cap US, real estate, cash, non-US large cap, emerging market stocks, 11 different things, and then gold and silver. We added gold and silver to it. And you see that 15% of the time over the last 21 years, gold has been the top performing asset class. And 15% of the time, silver was. You add those up, and you look at number 2 and number 3, gold and silver have performed very well relative and comparative to other assets over the last 2 decades. Shouldn't be surprised, but it is. This is the first quarter. We don't have the second quarter of this year because the second quarter is not done yet. Second quarter will probably be far less positive for gold and silver. But take a look at the first quarter of this year. And I put in 2020 and 2021 just for comparison purposes. 2020, gold and silver and gold were the top two performing assets out of 11 asset classes. 2021, they were close to the bottom. Silver was the worst performer simply because it had already risen in 2020. And those people who were disillusioned because the price didn't rise to $100 or $700, some of them were selling. It shouldn't have, but some of them were. Gold didn't do so well either last year. In the first year, silver was a top performer, 7.6% return in the first quarter. First, there was inflation fears. Then there was concerns about what the rise in interest rates would do to the economy. Then there was the Russian invasion of Ukraine. And silver had, beginning of the quarter to the end of the quarter, 7.6% increase. Gold had a 6.6% increase. The third best performing asset was cash at 0.6%, less than 1/10 of the return that silver and gold made. And then you can see all those other asset classes ranged, well, after cash, they were all negative, from -2% to -7.5%. So gold and silver performed very well. And when somebody tells you that gold and silver prices aren't high and they're not rising in the face of a lot of these concerns, we don't know what they're talking about. Or they're trying to fool you. And there's a lot of that going around. Silver coin demand, it's remaining very strong. Remained strong last year. Our projection is that it stays strong again this year. We're seeing that in the year-to-date figures so far. The blue bar here is the first 4 months of this year, and the red bar is the first 4 months of 2021. So it's down from 2021. First 4 months of last year saw pretty strong demand. Part of it was because of we're going to squeeze the silver market, so let's pay 30-40% premium for silver coins. And then on the right-hand side, you see the premium. You see the premium for the silver eagles, which have very high premium because of the shortages, because of issues related to the quality control of blank manufacturing. And anybody who tells you that anything other than that is misleading you and probably doesn't know what he's talking about anyway. The lighter blue line is the premium on 100-ounce bars. And you can see that also has risen. I actually was at a luncheon, industry luncheon yesterday, and a fellow who's new to silver came up to me because he wanted to buy silver, and he was thinking about buying 100-ounce bars. And then, given the volume of silver he wanted to buy, I told him to focus, buy some coins, probably maple leafs, although the premiums are very high. But most of what he buys should be 1,000-ounce bars stored for him in a reputable registered depository and left there. Because if you take it out and then you bring it back, somebody's going to say, well, maybe I need to assay this to see if it's been tampered with or what it is. If you leave it in the depository, like those eligible stocks, you don't have to worry about anything like that when it comes time to take your profits and sell it. Yeah, rose very sharply in 2020. We've discussed this in past reports and presentations about the fact that a lot of that was actually disgorged metal from investors that went into bullion banks, and then it went through this process of going from bullion bank depository holdings in London to ETF shares to being sold as ETF shares. Fabrication demand quickly risen sharply over the last 30, 40 years. It's recovering from the pandemic and lockdown. It's not back to pre-pandemic levels yet. We don't expect it to be there this year, but it is moving that way. Silver use in electronics, which is an enormous application. I mean, it's everywhere. It's not just electronic goods and stuff. I mean, electronics are used in all sorts of things now. It's risen very sharply. It used to be 60, 80 million ounces a year. Over the last quarter of a century, it's gone up to about 220 million ounces. Part of that is in the auto sector. And you can see this silver in the auto industry as automakers have loaded their cars with electronic distractions. People aren't bad enough drivers. They need more electronic distraction. And it's very important to understand this growth from 6-7 million ounces to 35-40 million ounces is in conventional petroleum fueled vehicles. This is not the advent of electric vehicles. And you'll see, I mean, I guess you use about an ounce of silver per car right now in conventional vehicles. And the estimate in electric vehicles are using about 1.5 ounces. So it's an increased use of silver moving to electric vehicles, but it's not the 5-fold or 7-fold that some of the marketing people tell you. It's more like 1.5 to 2 ounces of silver per electric vehicle compared to 1 ounce for a petroleum fueled internal combustion engine vehicle. But it is there and it is growing. It's one of the factors that's contributed to that strong growth. This silver in auto use is included primarily in our electronics use because it is in electronics. Solar growth also rising. We expect a record amount of silver to be used in solar panels this year, and it's going to continue to grow. It will be important. It is now 12% of fabrication demand, perhaps, and it's growing in size. Supply is back to 2018 levels. It has now gotten back to pre-pandemic levels. And here you can see back in the late 70s, early 80s, we were mining 450, 500 million ounces of silver at the time when we had 8 billion ounces of reserves, and people were saying we're going to run out in 20 years. And 40 years later, we have twice as much reserves as we did before. This is the cash cost curve for primary producers. And you can see, let's go to the 50% mark. The average cash cost is about, well, it's written right there, $6.48 in 2020, and it rose to $8.27 in 2021. That increase in cash cost had to do with the higher silver price, which caused the mining companies to mine a lower average grade, which is a standard practice in mining to maximize your output and profit in the long run of a natural resource that's a depleting asset. But $8.27 on an average, you can see that 10%, actually, you're close to 30% of primary silver production is free, or you actually earn money on it because of the value of the byproducts, gold, copper, lead, and zinc. And you can go way out here to 90%. And at 90%, you're still $10. Now it's up to about $15 an ounce. So on a cash cost basis, being a primary silver miner is profitable. And people should not be thinking that these are loss-making industries that are contracting because there's no profits. There's big profits. And of course, only about 25%, 30% maybe, of silver mine production comes from primary silver companies. The rest of it comes from byproduct companies. And those byproduct companies, they'll account for their silver costs in different ways. But some of them say, okay, I'm mining gold and copper, and I can mine the copper and the gold is free, and I can mine the gold and the copper's free. That's how low my costs are. And this is a byproduct silver. After I've refined the copper, I refine the gold. After I've refined the copper and gold, I have what's called tank house slimes. It's electrolytic refining, and it's the slime and sludge, everything else that was in those cathodes that were electrolytically refined to get the copper and gold out. Everything else is in that sludge. And it might include lead and zinc, silver, tellurium, selenium, all sorts of things in there. Some byproduct producers will say, when I take those tank house slimes and I send them to a refinery to be processed to get the silver out, it cost me 50 cents an ounce. So that's my silver production cost. Others will say, no, it's a percentage of the mining and refining up to that point plus 50 cents. But the reality is that silver is a pretty profitable business to be in, being a silver miner. Final chart. These are our current projections for silver supply and fabrication demand going out 10 years. Investment demand, as I said earlier, is the factor that really drives the price upward or downward. Investors don't want it, they're selling it, the price falls or stays $5 an ounce. Investors want it and the price goes up. That's the gap between fabrication demand and total supply, including scrap. And again, you can see here, investors were bidding up the price, keeping the price at $7 or $8 or $9, discouraging fabrication demand to some extent, and encouraging supply. And you saw the investors do that. Then they flipped to being net sellers, and they supplied the shortfall of fabrication demand to supply. Going forward, here you can see the long period since 2005 of net investment demand. As it goes, we go forward over the next 10 years. In the back half of the next 10 years, CPM Group has fabrication demand rising sharply and total supply relatively flat. So that gets really small. And the reason why we say that we think the silver price is going to rise to record levels later in the decade is because when we look at this gap, which is ostensibly the silver that's left over for investors, but investors are the prime actors here. They don't buy the residuals left over to them. They decide how much silver they want. If they want more than's left over, they're going to drive the price higher to encourage supply and discourage fabrication demand. And if they want less than what's left over for them, the residual here, then they're going to let the price fall. Our expectation is that in the second half of this year, of this decade, you will see a tightening of the supply-demand balance to levels that will be insufficient to meet investment demand, and that investment demand will push the price of silver to record prices for a time before they come off, because there's ample amounts of silver in bullion form, in coin form, and in mineable reserves to meet future supply. The question is, at what price? That's what I've got. Again, this is our silver reports through the years, the silver price chart here report. This was from the early 1970s at J. Aaron. This is early 1980s J. Aaron annual silver review and outlook. I had taken over the department, but even before I took it over, they had improved the quality of the production from the early 70s to the late 70s. After we left J. Aaron, merged into Goldman Sachs, and we left Goldman Sachs in 1986, we started producing a precious metal silver survey, quarterly and an annual. It became a yearbook, and it continues to be a yearbook. It's translated into Chinese by the Shanghai Huatong Silver Exchange, our partner for silver. This is an old Handy and Harmon report. They were the other people who did fundamental research on silver supply and demand prior to the early 1990s. In the early 1990s, from 1990 to 1994, the Silver Institute asked us to create a world silver survey which was to be a stripped down version of our quarterly surveys. Our quarterly surveys were $2,000, $2,200 a year subscriptions. And so you had to be a pretty significant participant in the silver market to buy that research. That's pretty much all that was available. So the Silver Institute asked us to supply stripped down CPM Group silver surveys and create the World Silver Survey. We did it for 5 years, but what we found was that they wanted us to be more bullish than we were. They wanted us to distort the statistics, include investment demand with fabrication demand in our supply-demand balance, which then distorts your price expectations. They wanted us to do other things that we didn't want to do. They were really upset when we said, oh, there are billions of ounces of silver in refined inventories around the world. So after 5 years of producing the World Silver Survey under the initial 5-year contract, Silver Institute and CPM Group went their own separate ways. And we continue to be, of course, for really good data that's unbiased. And we're not marketing silver, we're marketing silver research. You can find out about it on this. That's my presentation. Let's see if we have some questions here. You're gonna have to excuse me while I put on glasses and run with this. What is your long-term gold to silver ratio prediction, please? I actually don't have one. When people ask that question, and if somebody asked me that question and I wasn't on a video right now, I would take our long-term projections for silver and gold prices and divide one by the other. And honestly, I think the gold-silver ratio is so unimportant that I haven't even done that. I mean, we obviously have 10-year projections for gold and silver, and we update them continually. And we produce quarterly reports for clients that want them on our 10-year outlook for gold and our 10-year outlook for silver. And as far as I'm concerned, the gold-silver ratio is so important that I don't even know what that ratio would be if I took one of our projections and divided it by the other. Sorry to say, but I just don't know. Are there any other questions here? The next 4 quarters, what supports the bullish case? Well, first off, I don't have a particularly bullish case for the next 4 quarters. The negative side is rising interest rates, some signs of ongoing disenchantment and weakness in investment demand. But the positives are we have governments around the world working 24/7 to give us all sorts of reasons to be worried. Fiscal problems, financial problems, excess money supply, incompetent governance, hostility among governments, hostility within governments. There are questions, political issues about the United States. I think you're going to have a very nasty election process in the midterms this year. That will be supportive of silver and gold prices because it will cause investors to be concerned about the state of the country. You have similar things going on in Europe. You have the Russian invasion of Ukraine, which is scrambling international relations were deteriorating sharply already, and they were headed for big problems. And the Russian invasion of Ukraine has scrambled it and made it that much more interesting and more difficult. So I think that you're going to, the way I look at it is the bullish case, the things that are supportive of silver over the next few months, relatively strong fundamentals. Investment demand, yeah, there's some deterioration in it and some dissatisfaction, but investment demand remains relatively high. We're seeing investors buying it, so it's there. I think there'll come a time when people will say that interest rate increases are not necessarily as negative for other assets like gold and silver and for the economy as they seems to be the consensus right now. Interest rates are rising, but they're rising from a very low level. They're still negative on an inflation-adjusted basis. Interest rates can rise very sharply along the lines of what the Fed indicates it thinks it will do, and still be at historically low levels that probably will not turn off the economy, throw us into a recession, or cause other problems. So I think that a relaxation of anxieties over the interest rates is probably one of the most important bullish factors that's there. Is the average grade of silver reserves in 1988 versus 2020? I don't have those figures at the top of my fingers. At the top, I keep them in my head. So I just won't answer that one. We do have those numbers. In our 2021 report, we showed the relationship between rising prices and falling ore grades. And that's a very important factor because, again, you had these guys in the market in 2021 saying, oh, the world is running out of silver and the falling ore grade proves it. And we showed, no, the ore grade has fallen, say, from 2013 to 2021 because of rising silver prices, actually, over the last several years. And you know, when the price falls, you mine a higher grade. And when the price rises, you mine a lower grade. And your reserves are calculated based on prices. And one of the big issues that regulatory agencies in Canada, the United States, Australia, and elsewhere have with mining companies is what number are you using to calculate your reserves? You know, I think a lot of silver mining companies probably are using 12 or 14, maybe $16 an ounce to calculate their reserves, which is a very conservative view. There are some people who want to say, no, the price is, you know, $28, $26, well, it ought to be $50, but let's use $30. Those guys usually don't pass muster with a regulatory agency. So I'm not quite sure what the ore grade was in 1988. So that's all I can tell you. How should the rising cost of oil influence the cost of mining and ultimately be reflected in the inflation in gold and silver? Well, energy costs are one of the major two components for mining gold and silver and other things, the other being labor. And the energy costs are very significant. They will exert, and they are exerting upward pressure on the prices. But they also have an offset, which is that as companies and have to pay more of their available money for oil and gas, they buy less of other stuff. And so that can actually have a negative impact on the prices of non-energy goods and services. EIA forecasts 500 million ounces of silver demand from solar over the next 30 years. Actually, I would think that's pretty too low. I think you must be thinking 500 million ounces of silver per year in 30 years. And that's probably too high. There are a couple of issues there. And one of the things to watch out for, and I don't look at the EIA data, I look at the IEA data, the International Energy Agency. And they look at, you know, they have different scenarios. And there's the big scenario, which is called the sustainable development scenario. And this is probably a sustainable development scenario, saying, oh, if all of the governments lived up to all of their promises of reducing greenhouse gases between now and, say, 2050, this is what would happen to solar demand and silver use in solar panels, et cetera, et cetera. But the sad reality is that the governments have not been living up to their Paris Accord agreements, and they will not, and they probably cannot politically. So the IEA has a separate scenario called STEPS, which is basically, okay, let's look at the world as it is. Let's look at it on a normative basis. And let's assume that the world continues to bump along in the inappropriate and inefficient way that it has for the last 2,000 years or longer. That scenario has much less solar. Another factor to kick in there is at some point, solar panels reach the end of their useful life. Sometimes it's because technology changes. So, for example, our solar panels that we have, our agreement with the supplier is that at a certain level, if the efficiency falls, they replace them. Or if the efficiency of new generation panels exceeds a certain percentage of the existing panels' existence, they replace them. And there will be over time, and again, remember that chart on solar panels, we're really only like 14 years, 16 years into a period of things. But as this goes, there's this cumulative amount of silver in solar panels in place. And as this goes forward over time, over the next 30 years, you will see end-of-life silver coming back, being recovered from spent panels. So when we look at this forecast, we have two forecasts going forward for silver use in solar panels. One is, what is the gross amount of silver that will be used in the solar panel, photovoltaic panel industry? And what is the net use after accounting for the silver that will be being recovered? And some of it already is being recovered, but the pool of end-of-life panels is relatively small now. Over the next several decades, that pool is going to be enormous. If you go back to the period 1950 to 2000, when photography was the largest use of silver, and people would say, well, we're worried that you're going to lose 250 million ounces a year of silver demand if photography goes digital. And so, yes, that's true, but you're also going to lose 150 million ounces of silver scrap recovery from spent photographic papers, films, and other materials. So your net loss of a market is, on a net basis, after accounting for the recycling of spent photo products, is about 100 million ounces. The same will apply going forward with solar panels. So when you start talking about the next 30 years, you have to have a realistic view of what's really going to happen in terms of energy conservation and the rise of solar panels. And B, you have to consider the issues of end-of-life silver, solar panels and silver coming back from it. How do you think we can educate the public and small investors that the world is not running out of silver and that the reserves and resources are more based on economics? You know, we try. And the reason why we agreed to do the World Silver Survey with the Silver Institute back in 1990 was we thought that this was a way to spread good information, unbiased information, accurate information to small investors and the public. I mean, and I'll be honest, the Silver Institute came to us in the late 80s and said, hey, the silver price has gone from $16 an ounce to $7 an ounce, and investment demand has gone from 180 million ounces down to 40 million ounces, and it's shrinking. Why aren't people buying silver? And we said, well, first off, no one's selling silver. Banks and brokerage houses that were big sellers of silver in the early 80s had gotten out of the business. Second thing is the information is not available. You can spend $2,200 a year on CPM Group's research, or that's it. Oops, that's it. So the information is not available. In addition to that, by the late 1980s already, you had about 35% of the assets under investable assets in the United States being managed by professional money managers. It's now much, much higher. I think it's well over 70%, probably over 80% of investable funds in the United States and elsewhere managed by professional money managers. These people grew up in the equity market, where you have equity market regulators saying, hey, you can't publish garbage like that. You know, the things that people write about silver and gold, if they were writing about an equity, they would be in prison, or they would be banned from the securities market. You know, and some of them actually have been, and they got into gold and silver because they couldn't ply their trade in the equity markets anymore. So you know, you don't have that, and the other people are coming out of the bond market where it's all math. So you have to make that available. And one of the things that we had proposed to the Silver Institute, which they never really did, was to try to have a much more aggressive approach in going off to banks and brokerage houses and encouraging them to make information available. We did this with the Platinum Guild International in the 1990s into the early aughties, and we developed a big healthy growth in investment demand for platinum at that time. We've done it with the Royal Canadian Mint at times, with the U.S. Mint, with the Australian Mint, the Perth Mint, and a variety of other entities over time. But you need to have an accurate marketing system to get that information out there. And you have to be cognizant of you're dealing with it that is really full of charlatans, scammers, liars, and people who just don't know what they're talking about. You know, so somebody needs to market it, and somebody needs to market it responsibly. And I have to say, we are incredibly grateful to the people the companies that sponsor our silver yearbooks and our gold and platinum yearbooks, as well as this web seminar and our PDAC work, because those companies are doing that in order to get credible, unbiased, accurate information and analysis out to the markets. And that's really what is needed. And somebody needs to spend money on it, but there are a lot of people who say, I'd rather spend less money on bad information and hype this thing, because I'm not looking to be in the silver market the way you have, Jeff, for 50 years. I'm looking to make a killing and get out of here and move to Southern California, and then I can brag about my ranch. Is there a positive correlation between silver and the S&P? I've noticed at times, and there are times when it's there, but the overall correlation is very low. I think it's probably less than 10%. There are times when silver rises at the same time as stocks and both fall at the same times, and then there are times when they move in opposite directions. And that's actually one of the valuable aspects of gold and silver, the very low correlation to equities and bonds statistically over time, because you don't want a safe haven or a hedge, a portfolio diversifier that just moves in the opposite direction. You want something that's uncorrelated. So that low correlation is very beneficial to investors who are looking to do this. More on inflation. If you were looking for an inflation hedge, better to invest in bullion or miners. I typically suggest that people invest in both bullion and mining equities. I think that if you're looking for an inflation hedge, I would go for bullion rather than mining companies. Mining companies have a lot of other issues that you have to pay attention to. You have a very long track record. Looking back, how accurate did your previous price forecasts turn out to be? And what did you learn most when they were the least accurate? We have produced charts and tables showing our intermediate term supply price projections, where we said to investors for the next 2 or 3 years, I would be a buyer or I'd be a seller. And the track record is really good. It is available in various videos that we've made over the last 2 years, as well as various reports. I didn't put it in here. I apologize for that. But it's pretty good. What have I learned? In our silver yearbook, we have a table, a chart, which is actually, it's cumulative, and it shows, sorry, shouldn't bother with this, but it shows the chart. I don't know that you can see it, but it shows cumulative mine production and its distribution over history. And it's about 58 billion, 59 billion ounces of silver that we estimate has been mined. And, you know, there's about 4 billion, 5 billion in coins and bullion. There's about 26 billion ounces that's believed to exist in jewelry and decorative objects and silverware and religious goods. And then there's another 26 billion ounces that is just lost to history. And one of the things that we have seen over the last 40 some odd years of doing this work is there's a constant stream of silver that comes out of jewelry and decorative objects and silverware and other places. And it doesn't get picked up as mainstream secondary recovery of old scrap. It gets refined. Sometimes it doesn't get refined, it just gets reused. And that flow of unreported silver back into the silver market from fabricated products is probably the most confounding issue that we face as silver mining or silver market analysts, trying to discern, you know, how much silver is out there and how much is being bought and everything. I mean, mining companies are good at reporting information. They have regulatory obligations if they're public companies. They want investors to invest in them, so they have an economic incentive. But secondary refiners, fabricators, investors, they have no economic incentive and no regulatory requirement to disclose how much metal they're producing for secondary refiners, or using for fabricators, or investing for investors. And that makes it a very secretive and difficult market to be an analyst in. So that's one of the things. Good evening, sir. So I guess you're from someplace else. Themba, interested to invest in silver. I don't have information of what must I do to participate, and you're based in South Africa. Themba, send an email to info@cpmgroup.com. Tell us what your interests are, and we will respond to you. I'm sure we can help direct you toward suitable ways to invest in silver. I pick up on what I mean, but a better second question is there a positive correlation at times, I guess, with the S&P? And what do you think that correlation is? I just don't know. I guess that's it. Yeah. There are at times better correlations. I don't have it in front of me. Sean, we can talk about that. More on inflation. If you were looking for an inflation hedge, okay, I got that one. Does CPM Group look at other metals resources besides the precious metals? Do you have plans to? We have always, I actually started off in energy markets in the university, got into alternative energy, wrote a newsletter on electric vehicles in '78, wrote a book on electric vehicles in '79. I was going to write a book on solar panels and wind power in 1980, but I decided not to. We have always worked on oil and gas. We do some work, mostly hedging strategies and some investment strategies in agricultural commodities. We have a base metals advisory that covers the 6 metals traded on the LME, the base metals. We have a lot of research on high purity manganese, which is a material that goes into lithium ion batteries for electric vehicles and electricity storage systems. We have a molybdenum practice, we have a tantalum practice, and then we do work on a specific basis. So clients will retain us to advise them and show them 10-year, 20-year, 30-year projections on uranium or vanadium or lithium or a variety of other metals. We're actually right now talking about scandium. It's a metal that we did some work on maybe 10, 12 years ago, and it's coming around again as something interesting. But a lot of companies will turn to us. So, you know, I know that 5 years ago or maybe longer, hedge fund bought everybody's long-term lithium supply demand price outlook report. And we had ours going out 10 years or longer. We might have been going out to 2050 already. I don't think so. But we had 10 years of projections, and we had secondary recovery of lithium from spent batteries in our supply. And they retained us based on that, simply because nobody else was thinking that all of these batteries that would be being used would be recycled. You know, and one of the ugly secrets about lithium ion batteries is they are recyclable, but much of the recycling is let's take the cobalt out and burn off the lithium. And that has to change. It is changing. And you're now seeing more people who prognosticate about future lithium supply demand price plugging secondary recovery into their models because it's going to be such an important factor. So yeah, we do look at these metals. We do it on an opportunistic basis. When somebody pays us, we're there. Will copper silver paste replace silver in solar? You know, probably not, because the whole key in silver in solar panels is the efficiency, and the efficiency is heavily dependent on the silver content. You can see from this chart, which I still have up, you know, when the silver price rose sharply in 2011, the next year you saw a big decline in the amount of silver being used. And that was thrifting, and it was moving to less silver per panel and per kilowatt or of silver of electricity production capacity. And for a couple of years that persisted, but then it gave way, and we're now using probably, well, we're using less silver per panel, but we're using probably the optimized amount. But that said, you know, solar panel manufacturers are constantly looking for an alternative to silver. At $21, $22 an ounce, silver is expensive raw material. But the comparison is platinum group metals used in auto catalysts. I mean, the auto industry has been looking for alternatives to platinum group metals in auto catalytic converters since the 1960s. Yeah, we didn't start using catalytic converters until model year 1974. So, you know, manufacturing year 1973. But the auto industry said, you know, platinum at the time, $200 an ounce, palladium was $80 an ounce, rhodium was God knows what, it's very low. Yeah, these are expensive raw materials. So they have spent tens of billions, hundreds of billions of dollars looking for replacements for PGMs over the last 50 years. Haven't found them yet, but they'll continue to look. And the solar panel industry will continue to look for things that they can do. The outlook for silver usage in battery electric vehicles and fuel cells. Virtually, well, the silver use in fuel cells would be in the electronics. And since we think that fuel cells will have relatively limited applications, we don't see tremendous growth in silver demand there. In terms of battery electric vehicles, it is, as I said, you know, probably 1.5 to 2 ounces of silver per vehicle. And then you have to say, well, how many vehicles are you going to be making? You know, some people think that you're going to have 20 or 30 million battery electric vehicles per year being made by the year 2030. So that would suggest, you know, 30 to 60 million ounces of silver being used in battery electric vehicles. Other people have much bigger. There are people who think that we'll have 60 million battery electric vehicles being made per year by 2030. The capacity to do that and to generate enough electricity to meet the electricity needs for that many electric vehicles won't be there in 2030. So that's probably an unrealistic expectation. But yeah, you're looking at something that's probably going to be adding tens of millions of ounces of silver demand. Will the silver coin premium at these levels, does it make sense to cash in on that premium by selling the coins and then buying bars? I could afford more ounces and get more. It depends again on who you are and what your size is, you know. And I like the idea of having some silver coins, but you know, in the 1980s, there's a wonderful lady who her husband had built a company, had sold it. Goldman Sachs sold it for him, earned a couple $100 million dollars in selling it, and then he had passed away. And someone had gotten to her and said, you should buy $50 million, you should take $50 million worth of your wealth and put it into silver coins. As a time when silver was about $5 an ounce. So, my job was to say to her, putting $50 million into silver might make a lot of sense. And you might want to buy, a couple 100 ounces of silver coins, but you probably don't want to buy 1 million ounces of silver coins because that's pretty much what they're making these days. So most of the silver you buy should be 1,000-ounce bars stored for you at secure, reputable depositories, recognized, registered depositories, so that you can buy and sell it as you see fit. That same is true. I gave the same advice to somebody yesterday. Wasn't talking about $50 million. He was talking about a few $100,000. And I said, yeah, you don't want a few $100,000 worth of silver coins. You want some silver coins, they're nice to have, and they could come in use in some extreme economic and political circumstances. But mostly what you want are 1,000-ounce bars. And as I said, we did have this one client, or actually not client, because she was penny wise and pound foolish, and she didn't retain us, but she got free advice because I'm a nice guy. We actually clawed back about $750,000 that she had overpaid for high premium coins at the top of the market. And then we had her swap those coins for bars because of the lack of premium. So depending on who you are and what size you are and what everything that you're involved in, it can make sense or it cannot. Thanks for these presentations. My question is this: when will we see platinum regain their status as the most valued precious metal? What is your outlook for short and long term? We think that the platinum price is in the process of moving higher. We think that, we've been expecting it over the last year, this year, next year, to farm a base around $1,000. It's testing $1,000 hard right now and probably will fall below it in the third quarter. But we do think that the price rises. We think that because we have a more realistic, slower introduction of electric vehicles, people don't realize, again, go to the International Energy Agency and get their energy outlook. They think that by the year 2050, the major source of energy for humankind will still be oil, petroleum. Natural gas will be number 2. All renewables combined will be number 3. And coal will be number 4. Right now, it's, I guess, oil, coal, natural gas, and all other renewables are very small. Right. And we're going to be petroleum dependent for decades to come. And as long as we're petroleum dependent, we will need platinum, palladium, and rhodium to clean up the exhaust. Because while they have spent tens or hundreds of billions of dollars looking for alternatives, they haven't found them yet. So we think that as long as we're petroleum dependent, you're going to need PGMs. And there will come a time, possibly within the next decade, where platinum gets re-rated. So that's the good news about platinum prices. Bad news is I don't know that platinum prices will ever exceed gold prices again. And I say that because gold is a financial asset that has been rediscovered over the last 22 years. And there is a renaissance among among investors saying, I should own gold. And I think one of the things that's misstated about gold and silver all the time is that these are not mainstream investments, because you have this fringe out there that talks about it on the internet and elsewhere, gun shows, and people see that. But there are a lot of mainstream investors who own gold and silver, and they don't like to talk about it because, quite frankly, they don't want people to think they're crazy. And I think that gold will continue to shine as a financial asset, as a portfolio diversifier, as a safe haven, as a form of savings, as a hedge against inflation, currency market volatility, political unrest, domestic and foreign. And I think that gold will probably maintain its premium over platinum as a result of that, even as platinum prices rise. So I guess that means I'm more bullish on gold too. And what do you think about fiat money value potential risk change versus in the economics versus demand for gold and silver prices this year? You know, the definition of fiat is it's by decree. What's the price of gold? Well, it's by decree, it's $1,860 today. That decree is issued by the market. In 2001, the price was $260 an ounce by decree of the market. Prior to 1968, the price was $35 an ounce by government decree. A fiat currency is something that has its value decreed. Gold has its value decreed. Yeah, talking about fiat currencies is to sort of say like, well, the problem is with Democrats or Republicans. If you think in terms of Democrats or Republicans, if you think in terms of conservatives or liberals, you don't understand the problem. And if you think about fiat, if you talk about fiat money, you don't understand the problem. Every major currency system ever created by mankind, except the current one, has collapsed. Almost all of them were based on gold and or silver. Gold and or silver did nothing to protect those currency systems from depreciation and ultimately collapse. Takeaway is that you should assume that this currency system gets replaced at some point too. Will it get replaced by a bunch of countries that hate each other getting together and saying, hey, let's do something intelligent for a change? Probably not. Will it get, will the transition to a future international currency regime, which I've been studying since the 70s and talking to central bankers about since the 1980s, will that be more volatile than a sensible, logical, let's get together and sort this thing out? Probably it will be. In that kind of environment, gold and silver will do well, and they will continue to do well. And it's not so much fiat money, it's the nature of money and currency systems. International currency regimes come and go. Doesn't matter whether they're backed by gold or not. So currencies backed by no one, they'll go. They'll go the way of all those tech stocks. You know, when the NASDAQ lost 86% of its value during the tech stock boom bust. Watch for that in cryptos. Okay. I think that's about it. Gone a longer time than I thought we would, but very good questions. I have to thank you all for those questions. They're very good. I really appreciate it. You know, I particularly like the one about how can we get good information out to investors, retail investors. I mean, I've been doing it all my life. I guess I haven't been doing it very successfully because the market is still full of cobwebs, but you do what you can. Until the next time, thank you for listening in, and let us know if we can help you. info@cpmgroup.com if you have questions or comments that you want to give us. Thank you.